It's very important to report your losses on your taxes. I mean, it's very sad that you had a loss and nothing's going to bring that back, but at least there's a silver lining in the tax code that you can actually reduce your other gains by the losses that you had. I was just talking to a guy last week, and he had roughly $20,000 in capital gain, $40,000 in, let's say, staking rewards, and then he had $100,000 stolen from him through a hack. And what we did by reporting it this way is it really grieves me when I hear crypto investors who had major losses from theft or rug pulls or hacks, and they tell their tax preparer, I had this loss. And then the tax preparer says, well, you can't do anything about it. Personal losses can no longer be written off because of changes in the tax code. Nothing could be more wrong than that. And it's very misleading. Most people don't lose their investments. All right. You bought some stocks at Fidelity, you're not going to lose them. You invested in some company, it doesn't go away. But a theft, like we experience with crypto, is like a rug pull. The whole, it's almost like somebody came into your house and stole it from you type of feeling. That's why people tend to think of it as being a personal loss. We have a crisis in this country. We have a drastic shortage of CPAs, and fewer are entering into the profession. Tax preparers that are experienced and knowledgeable, like enrolled agents, there's not that many of them, and they're focused on other areas. But in the crypto space, most of them just pull out this, losses, unless it's in a federal disaster area, you can't claim the loss. And they don't think hard about it because they really don't understand that crypto is an investment. Yes, the TCJA, which is the name of the tax bill from 2017, made it so if you had personal casualty losses, could no longer be deducted on Schedule A of your tax return and deducted from your income. And that's true. That means if your car is stolen, that's a personal asset. But when we dig into the tax code, section 165, subparagraph H, it talks about what is a personal casualty loss, and it refers it back to subparagraph C. And there's three types of losses. There's business losses. There's losses resulting from investments. It's called investment losses. It's transactions entered into for profit purposes, all right, which is crypto investing. The third type of loss is loss of personal property. Now, it's true that a cryptocurrency is, it's your property, it's personal, but under the tax code, section 165C, it's defined as an investment loss. And that change in the tax law that most tax preparers are confused about does not apply to cryptocurrency theft, whether it's a hack, whether it's a rug pull, or you just got scammed somehow. All these things are deductible. Now, how do you report that? The simple solution to that is basically to enter an investment loss in on your form 8949, which is, it's basically a spreadsheet type of form listing all your trades. Just enter in a trade where basically it looks like you sold it for $0. Proceeds column says zero, cost column says whatever you paid for it, and it shows up as a loss, a negative amount. So that's the simplest way to report it. There are more sophisticated ways, which we use for our tax customers, but at that very least, that would be good. If you have evidence that proves that you actually experienced this loss, you want to keep that in your records in case you're audited, over the next 3 to 6 years. Basically save everything for like 7 years. That's a general rule of thumb. If you filed a police report, if you filed a complaint with the Federal Trade Commission or whoever you reported stuff to, whatever documents or evidence or communications you had with the exchange, anything that can prove that other people had the same experience, just print it out and keep it in your personal records so that you could show later that this actually did happen, as opposed to the IRS having to take your word for it. But I mean, I was just talking to a guy last week, and he had roughly $20,000 in capital gain, $40,000 in, let's say, staking rewards, and then he had $100,000 stolen from him through a hack. And What we did by reporting it this way is he had $20,000 worth of capital gains, and then we had $100,000 worth of loss. Only thing you can subtract is not the value of it when it's stolen. I should be clear about this. All you can subtract off is the cost basis, what you paid for it. So he had loss, and he's able to show that, and it reduced his taxes down to a great amount. Actually went below the amount of income he had, and he's able to save some of that excess to roll over to the next year. So it's very important to report your losses on your taxes. I mean, it's very sad that you had a loss, and nothing's going to bring that back. But at least there's a silver lining in the tax code that you can actually reduce your other gains by the losses that you had if you have some sufficient evidence to prove it.
Thank you very much for listening to today's show, and I hope you enjoy it. Please give us comments. We would love to respond to any questions you give us. You have tax questions that we can apply to. We will try to address it in future shows. Please hit like, subscribe, follow. Thank you. Have a great day.
The Clinton Donnelly Show, where we explore how taxation and regulations of cryptocurrencies affect your daily life as an investor. Clinton has a law degree in international financial regulation. He is an enrolled agent and certified as a cryptocurrency anti-financial crime specialist. He has clients in 71 countries. He is one of the top experts in crypto taxation in the US. This show is sponsored by CryptoTaxAudit.com, the income tax experts for US crypto investors. Are you frustrated with using online crypto tax services to calculate capital gains? Are you a high-frequency trader, DeFi, NFT, play-to-earn, or whale investor? Nothing is too complicated for the experts at CryptoTaxAudit.com. Are you frustrated that your accountant doesn't understand crypto taxes? Crypto Tax Audit uses a proven, bulletproof crypto tax return methodology to prepare a tax return that doesn't attract the attention of the IRS. Crypto Tax Audit also offers an exclusive audit defense membership service. It's like car insurance for your tax return. If your return gets selected for an audit of crypto reporting, they will defend you at no additional charge for the entire life of the audit. No one offers anything like audit defense membership. Go to CryptoTaxAudit.com to learn more and schedule a private tax consultation now. The opinions expressed in this show are not legal advice. Tax and regulations are complicated. Your situation is unique, so you should always consult a tax professional.